$38 trillion. That's the official US national debt number, and it's still climbing. But the more shocking number is this. For the first time in American history, Washington is spending more on interest than on national defense. More money going to past bondholders than to the military of the present. That isn't a trivia fact for economists. It's a warning flare. Because once interest becomes one of the largest line items in the federal budget, the country enters a new regime where the debt stops being a scoreboard and starts being a weapon aimed at your purchasing power. If you've ever walked through Times Square, you've seen the national debt clock glowing like a casino display. The digits spin so fast they blur, and for decades, we were trained to treat that clock like theater, like a scary graphic that never touches real life. Deficits don't matter. We owe it to ourselves. The economy will outgrow it. That was the story, and it worked, because interest rates were low, inflation was subdued, and borrowing felt painless. Then the math changed. When rates rise, a debt mountain doesn't just sit there, it starts charging rent. And today, that rent is approaching $1 trillion a year just in interest. Not principal, not payoff, just interest. The government is paying to keep the debt alive. Stay with me, because later in this video, I'm going to show you the part most people never understand. When a government can't realistically cut spending and can't realistically default, there is one remaining path it almost always takes. It's called a soft default. It doesn't show up as a missed payment. It shows up as your savings buying less every year, while headlines tell you everything is fine. Welcome back to the Dollar Watch. This channel is where we talk about the hidden economy, how policy decisions become price tags in your life, and how financial systems transfer wealth without ever asking your permission. Now let's ground this in reality. $1 trillion a year in interest is not a line item you casually absorb. And the reason this is happening now, rather than 10 years ago, is simple. Interest rates were artificially low for a long time, and the Treasury took full advantage. The US issued enormous amounts of debt in an era where the market was basically charging near zero rent for money. That era is over. When you refinance a massive debt stack at higher rates, costs don't rise gradually. They step up in waves as old bonds mature and new ones are issued at higher yields. That's the refinancing trap. You can pretend the debt is manageable when you're paying 1% or 2%. You can't pretend when you're paying 4%, 5% or more on an expanding base. And at $38 trillion, every single percentage point matters. 1 percentage point at that scale is hundreds of billions in additional annual interest expense once it rolls through the maturity schedule. This is what people miss. The debt problem is not just the size of the number, it's the sensitivity of the number. A society can carry a lot of debt if the cost of money is low and stable. But once the cost of money rises, the debt becomes a predator. It eats budget capacity that used to go to infrastructure, research, education, healthcare, defense. That money doesn't disappear. It transfers to bondholders, and that transfer is now competing directly with the basic functions of government. Here's the point where this gets structurally dangerous. In a normal household, when debt becomes suffocating, you cut spending, you cancel, you downsize, you sell assets, you stop the bleeding. People love to say, the government should run its finances like a family. That slogan collapses under the first contact with reality. A massive share of federal spending is not discretionary. It's mandatory. Social Security, Medicare, debt service. These aren't cute line items you trim at a committee meeting. They are legal obligations and political promises to tens of millions of people. Now add demographics. In 1945, America had a young population, a rising workforce, and post-war industrial dominance. Today, America is aging. More retirees, fewer workers per beneficiary. That ratio matters because it determines how many taxpayers are supporting how many recipients. As the ratio worsens, fiscal stress intensifies even if the economy grows. So when someone says, just cut spending, I want you to ask, which spending? Because cutting Social Security by 30% isn't a policy tweak. It's political suicide and social destabilization. Slashing Medicare isn't budget discipline, it's a national crisis. And even if you cut defense deeply, you still don't solve the structural math without touching entitlements and interest, which brings us to the nightmare loop that defines debt spirals: borrowing to pay interest. When interest costs are close to $1 trillion a year and the government is already running deficits, the Treasury has to issue new debt to cover existing obligations. That is the sovereign version of paying one credit card with another. It can run for a surprisingly long time, until it can't. This is where compounding flips from friend to enemy. In your investment account, compounding builds wealth. In a national liability stack, compounding builds fragility. The larger the base, the larger the incremental increases. A 5% rise on $10 trillion is one world. A 5% rise on $38 trillion is a different planet. Now here's the open loop that matters most. When a nation reaches this stage, there are only a few theoretical escape routes. And for the United States, 2 of them are functionally off the table. That's why the third route becomes the default, even when nobody admits it out loud. Option 1 is austerity. In theory, you slash spending and raise taxes dramatically to balance the budget and pay down the debt. In reality, to close deficits at this scale while covering interest, you would need measures that would make the country unrecognizable. Taxes would have to rise sharply for the middle class, not just the rich. You'd need significant increases in broad-based taxation. Spending cuts would have to hit the big programs, not the symbolic ones. That means entitlements. And you can already see the political environment. It cannot even agree on minor adjustments without turning into a civil war in Congress. Even if it happened, austerity of that magnitude would likely trigger a deep recession or worse. Pulling trillions out of an economy that has been intertwined with federal spending for decades would crush demand and destabilize employment. The medicine might kill the patient, so austerity is the clean solution on paper and the impossible solution in practice. Option 2 is default. Just don't pay. Countries have done this. Argentina, Russia, others. They restructure. They extend maturities. They impose haircuts. But the United States is not a normal sovereign borrower. U.S. Treasuries are the foundation of global finance. They are treated as the risk-free benchmark that underpins bank capital rules, pension allocations, insurance liabilities, derivatives pricing, and international reserves. Entire plumbing systems are calibrated to the assumption that treasuries will pay on time. If the U.S. openly defaulted, you wouldn't get a contained event. You'd get a global collateral shock. Liquidity would evaporate. Funding markets would freeze. The ripple effects would hit mortgages, corporate borrowing, global trade finance. The reserve currency issuer does not default unless the system is already collapsing, so default is the nuclear option, and nuclear options are avoided until the last possible second. Which leaves the third option, the one governments prefer because it looks polite. The soft default. A soft default means you pay every dollar you owe. On time. No missed coupons. No dramatic speeches. Everything looks solvent. But you repay the debt in money that has less purchasing power than the money you borrowed. You don't erase the debt by paying it down. You erase it by erasing the currency. This is not a conspiracy theory. It's a historical pattern. Ancient Rome did it by reducing the silver content of coins over time. Post-war Britain did it through inflation and controlled rates. The United States did a version of it after World War II. And in a world of high debt and political constraints, it becomes the rational path of least resistance. To understand soft default, you need one distinction: nominal versus real. Nominal is what you see on the statement. Your bond pays 4%. Your savings account pays 2%. You feel like you're earning something. Real is what happens after inflation. If inflation is 5% and your bond yields 4%, you are losing 1% of purchasing power per year, even as your account balance rises. You are being paid in full and impoverished at the same time. Negative real rates are how governments liquidate debt without admitting it. If the state can keep inflation modestly above the average interest cost on its debt, the real burden shrinks over time. The debt doesn't disappear numerically, it disappears in purchasing power terms. This is where the story becomes personal, because a soft default is not the government stealing. It's the government changing the unit of measurement. It's the yardstick shrinking while you're told the numbers look fine. And once you see that, you'll stop asking the wrong question. The wrong question is, will the government pay its debt? It will, because it prints the currency. The right question is, what will those dollars be worth when they're paid? Now we need to talk about fiscal dominance, because this is the modern mechanism that makes soft default not just possible, but likely. In the textbook story, the Federal Reserve is independent. It fights inflation. It stabilizes employment. It does not finance government spending. That's the mythology. Under fiscal dominance, the Treasury dominates the Fed, not through an explicit order, through constraints. Because when a country has $38 trillion in debt, the central bank cannot raise rates to Volcker levels without detonating the government's interest bill. Do the math. If average rates across the debt stack move toward 10%, interest expenses could reach levels that overwhelm federal revenue. That isn't tightening. That's insolvency on paper. So the Fed is forced into a narrow corridor. Keep financial conditions loose enough for the Treasury to function, but tight enough to keep inflation from running away completely. That corridor is where credibility goes to die. Because if the public believes the Fed will always blink to protect the Treasury, inflation expectations become harder to anchor. And once inflation expectations unanchor, real rates can remain negative for long periods. That's the sweet spot for soft default. It's also the poison for savers. If you want the most important reveal in this entire video, it's this. The US has already run this playbook before, and it worked. That's why it's being revived, upgraded, and more sophisticated today. After World War II, US debt to GDP was extremely high. On paper, it looked unpayable. The solution was not heroic austerity. The solution was controlled rates and inflation. The Fed capped yields. Inflation ran meaningfully higher than bond yields for stretches. Bondholders were paid, but their real returns were negative. The debt burden shrank in real terms. That is liquidation via negative real interest rates. It's quiet, it's bureaucratic, it's politically survivable, and it is a transfer of wealth from savers to the state. Fast forward to today, and the same strategy is available, but with modern enhancements. Instead of blunt yield caps, we have regulatory structures that create forced demand for treasuries. Instead of obvious inflation, we have inflation measurement methodologies that can understate lived experience. Instead of simple monetary policy, we have QE and balance sheet tools that can be scaled rapidly. History isn't repeating, it's being optimized. Now, I want to show you the 3 tools that make this modern soft default machine work, because once you see them together, the entire economy makes more sense. Why asset prices inflate, why wages lag, why the middle class feels trapped, and why the debt clock never slows down. Tool 1 is the captive buyer. In a truly free market, if a government's debt exploded, investors would demand higher yields to compensate for risk and inflation. Higher yields would force discipline. But the US Treasury market is not fully free. It is embedded inside a regulatory architecture that forces institutions to hold treasuries as safe assets. Banks are required to hold high-quality liquid assets to satisfy liquidity coverage ratios. Treasuries are the gold standard of those assets. Pension funds and insurance companies also have regulatory and liability matching incentives that push them into government bonds. This creates structural demand that doesn't disappear just because the returns are unattractive in real terms. So the government gets a persistent buyer base even when the deal is bad. That suppresses yields. That keeps interest costs lower than they would be in a fully unconstrained market. And it gives the Treasury time to execute the soft default via inflation. Tool 2 is the broken inflation compass. Many government obligations are indexed to inflation. Social Security adjustments, certain contracts, inflation-protected securities. If inflation measures rise sharply, those payments rise sharply. That's expensive for the state. So the state has an incentive to measure inflation in a way that reduces obligations. Over decades, CPI methodology has changed. Substitution effects assume consumers shift to cheaper goods when prices rise. Hedonic adjustments reduce measured inflation by claiming quality improvements offset price increases. The result is an index that can diverge from what households actually feel. I'm not saying inflation is fake. I'm saying the measurement is contestable, and small methodological differences compound into huge fiscal differences over time. If the index understates cost of living increases, savers and beneficiaries get less real protection than they think. That is financial repression disguised as statistics. Tool 3 is fiscal dominance enforced by central bank intervention. When private and foreign demand for treasuries is insufficient at politically tolerable yields, the central bank can become the buyer of last resort. Through quantitative easing, the Fed buys bonds, supports prices, and suppresses yields. The immediate effect is lower borrowing costs for the government. The downstream effects are asset inflation and currency debasement pressures. This is where you see the everything bubble behavior. Stocks rise, real estate rises, speculative assets surge. People feel richer on paper while their purchasing power erodes in daily life. It's a monetary mirage created by liquidity seeking a home. Now we need to talk about who pays, because soft default always has a victim class. And that brings us to an old principle that still runs the modern system, where new money enters determines who benefits. When money is created, it does not enter evenly. It enters through the financial system. Banks, primary dealers, large institutions get early access to liquidity. They deploy it into assets. Asset prices rise. The top decile, which owns most assets, gets richer first. By the time the effects reach wages and consumer goods, prices have already moved. The average worker gets the inflation last, not the liquidity first. That's why wealth inequality accelerates under monetary expansion. It's not only about effort or virtue, it's about proximity to the money spigot. This is how you get a K-shaped reality. Asset owners float upward while wage earners tread water. The middle class doesn't get robbed in one dramatic event. It gets liquidated slowly through negative real returns on savings and rising living costs. And this is why the classic advice of the last generation is failing people now. Save cash. Cash gets destroyed by inflation. Buy bonds for safety. Bonds can be real loss instruments in negative real rate regimes. The old 60-40 portfolio was designed for a world where bonds protected you when stocks fell and inflation was tame. In a financial repression regime, bonds can fail at their job. They don't hedge, they bleed. This is the part no one wants to admit because it is socially destabilizing. The system increasingly forces ordinary people into risk assets just to preserve purchasing power. Speculation becomes mandatory, not because everyone loves risk, but because the supposed safe assets are engineered to yield less than inflation over time. Now let's talk about the next upgrade to this machine, because this is where the story moves from erosion to control. Physical cash is an escape hatch. It allows people to exit the banking system. It allows you to hold value outside programmable infrastructure. It is friction. It is autonomy. A central bank digital currency, or a fully digitized dollar architecture, reduces that autonomy. In a purely digital system, money can become more traceable and, in some designs, more programmable. That means policy can be enforced at the account level. Negative rates, spending incentives, restrictions, targeted controls. I'm not claiming every future system will do this. I'm telling you the capability is the point. And once that capability exists, the temptation during a debt crisis becomes extreme. Because if your problem is too much debt and not enough growth, a programmable system allows you to manipulate velocity, enforce taxation, and apply financial repression with precision. This is not about convenience. This is about sovereignty over your balance. Now, I want to bring in one historical precedent that people think could never happen again, until it does. In 1933, during the Great Depression, the U.S. government criminalized private gold ownership through Executive Order 6102. Americans were compelled to turn in gold under threat of fines and prison. The stated rationale was stabilizing the banking system. The deeper reality was control over monetary assets during crisis. The lesson isn't that gold will be seized tomorrow. The lesson is that in emergencies, governments rewrite rules. And those rule changes tend to land hardest on people who don't have legal flexibility, offshore structures, or political leverage. So when you ask, is my wealth protected? You're asking the right question. Because protection isn't just what you own. It's how exposed you are to rule changes, inflation regimes, and financial plumbing decisions you don't control. Now let's bring this home with the verdict, and I'm going to say it plainly. The United States is not going to default with a bang. It is going to default slowly, politely, and bureaucratically through purchasing power erosion. The $38 trillion will not be paid back in real terms. It will be managed. And the management tool is a combination of inflation tolerance, suppressed real yields, captive buyers, and central bank support, what we call financial repression. That means if you're living by old rules, hoarding cash, relying on fixed nominal returns, assuming bonds are always safe, you are volunteering to be the absorber of the state's debt strategy. You are the balance sheet the system uses because you are the easiest to tax without calling it a tax. This isn't financial advice. It's financial physics, and the difference matters. So here's the question I want to leave you with, because it's the question that decides whether you remain a spectator or you become a strategist. If the government's largest expense is becoming interest, and the only politically survivable way out is to erode the currency, what exactly do you think happens to the value of your savings over the next decade? That's why we watch gold. That's why we watch real assets. That's why we watch policy language about inflation being transitory or manageable. Because those are not academic words. They are the vocabulary of soft default. If you want the next briefing, subscribe. In the next episode, we're going to map how this debt regime changes the rules for households, mortgages, wages, retirement planning, and the coming battle between inflation and recession. Because in a debt spiral, the state's survival strategy becomes your cost of living.